It's your boy, Rusty Russ, back with that video on how to trade options in the stock market. Specifically today, we're going to be talking about both the vertical put credit spread and the vertical call credit spread. It's actually a pretty complicated strategy, but it's actually not so complicated if you have Tastyworks, which is the broker that I have to trade options. I recommend everyone get Tastyworks if you're trading options. Because you need level 3 options, say on Robinhood, to trade the options. And it's just, guys, it's just way better to have Tastyworks. Trust me, like, this broker is specifically for options trading. And it's just, and Webull, it doesn't even let you set closing orders. It's pathetic. GTC closing orders. And then TD Ameritrade, I think, is a little bit complicated. It's just, especially for beginners, you're going to want to just use Tastyworks, guys, trust me. Okay, so let's get to it. So if you have the Tastyworks platform up on your computer, this is a desktop version, here's the ticker symbol. For example, I want to trade PYPL, PayPal, like we did last time. Okay, when you want to do a put credit spread, you always want to see short, put, vertical. Okay, because we're selling premium, short, put, vertical. Now, if you want to do a call credit spread, change that to call. So short, call, vertical. On your phone, it's sell, put, vertical, and then you hit go. And then on your phone for call credit spreads, it says, instead of short, it says sell, call, vertical, and then you click go. Sell and short are the same word. Okay, short, put, vertical, sell, put, go, etc. See? Okay, I'm going to show you what a short, put, vertical is. Just by looking at the graph, at the chart, you should be able to understand what this is. Great. Money here, no money here. I mean, really that simple, guys. It's a little bit more complicated than that, but on this day, let's see, where's the expiration? The expiration is right here, so this is the strike price. This is the expiration. Okay, this is the credit received. And this is your long strike, and this is your short strike. So since we are selling premium here, we are buying this. So what we do is, I'll get into that, but long strike, short strike. Okay, green, red, long, short. Okay, pretty simple. And this graph shows you the stock, and this is the stock price, right? $170, $190, $210, $250, etc. And this is PayPal, right? And then you can see the word PayPal in the background. So that's what's going on there. And then here is the price of the strike and the date. Okay. And down here, this is probability of profit. This is all bullshit. Don't read that. This is strikes. This is the strikes button, so you can move the strikes over to the right, the left, or the right. This is width, so you can make the distance bigger. When you're doing vertical put credit spreads, you want to keep those strikes tight like a tiger. Okay. Quantity. Let's say you might want more than one. You can get as many as you want. Okay. Okay. Expiration. You can decrease the expiration, so this would be 4:30. This video was posted 4:29, so that would be tomorrow, which would be 1 day, which would be crazy. And then a week out, 8 days, 15, 22, as long as you want. Just keep pressing. What do you want to do? And you see how the further you go out in time, it doesn't give you the options of the TOIT strikes. This is swap, so you can inverse it. Don't do that. Okay, up here. Delta, so this is probability of profit, which is stupid. This is delta, this is theta, this is max profit and max loss, and this is your buying power effect. So how much money it costs to enter this trade. Okay, so usually it takes the max loss plus the broker fee. This one has a $5 fee to enter, none to exit. And you get what you pay for. It's not freaking Robinhood. Robinhood's garbage. Don't use Robinhood, guys. So it would be $142 to enter. Your max loss is the cost to enter, and it kind of clears it up here too. And in this specific example, you would need PayPal on 5/7, which is May 7th, to close above $265 for you to make $108, and you would have to risk $142. And at the end of the trade, you get your $142 back, right, and $108. Okay. But you can move the strikes over, and things change. This one, with the strikes over a little bit, and the current price of this stock is around here between the bid and the ask, somewhere in between here. It sits here, but we're after market hours, so it moved after market hours. This is last as a market close, but this moved since then. So it's about 266.42, which is in between these strikes. Which also the distance between the stock is in between the strikes. That's called the dance floor. We would consider this at the money, if you will. It's called at the money. So you're at the money position, and you would receive it would cost you $115 to enter, and $135 is how much we get at the end of the trade, and then you're risking $115, but you get that back plus this at the end of the trade. Additionally, you don't have to wait until the end of the trade, right? For example, if PayPal does climb today, it's probably not, but because the market's about to crash because big tech earnings and all that. But look at the one before. Like, let's say a couple days ago, you got this one. You see how this one is like the price is 102, but let's say this one, right? Let's say you received $133 in credit, or 133 times 100, right? As the price of the stock moves up, like this one, let's say the price was here when you got it, right? This was at the money when you got it a couple days ago, and you received $133 in credit. As the amount of credit that is received on the market decays or goes down, and it will as the price moves up, you start to have gains. So you can simply close this trade and give it back to the market. In this instance, let's say you received $135 in credit, and now it's 102. You will collect the difference between that in profit, and you get your money back too. So you don't have to wait until the end. You can take like 20% and then move on. You don't have to wait. You take a 20% trade, boom, next trade. So that's what you can do. All right. So basically, what is a vertical put? And this is after you've looked at the charts. We have a charting video. Go ahead and watch that one if you don't know how to read the charts. But what is a vertical put credit spread? What is a call? What is a put? A call. A put is, if you're buying a put, you believe that it's a bearish assumption, and when you're selling a put, it's a bullish assumption, because you're on the other side of the trade. But basically, what a vertical put credit spread is someone is saying that the stock is going to be below $262, and they're going to pay you $6.35 per contract, and but you need 100 shares to do this, right? So you're saying, okay, I believe that you're going to be wrong, and PayPal is going to be above this number, 262, by the 7th. So I'll take your money, but I'll risk 100 of my shares to do that. And you're thinking to yourself, Russell, I don't have 100 shares. No problem. You just do short put vertical, and when you give back some of this money to buy this one, which is $5.55, let's look at the money one, which is $5.55 or whatever. This one's $8.75. Which is $7.80, which means you get back a lot of the money that you received to buy this one. And this one puts you in possession of 100 shares. So it means you're allowed to sell premium. Okay? And in this instance, you would receive $135 in premium. And let's say you wanted to buy just a few, maybe, $1,000 worth. And then this comes down 20%. You'd easily make $200 or $300 per position if you have like 1,000 or whatever. I mean, it's really an inexpensive way to make money, but there is risk, because if the stock moves against you, there could be some problems. You're gonna have to manage risk. That's why you want to give yourself at least 45 days. I mean, at least I like to do 21 days. So the expiration, 22 is fine. Increase the expiration to 22. So, and then you want to look at the chart and make sure that PayPal is trading near the bottom of its 20-day range. Right, and you want to be trading a stock that has good fundamentals and that is undervalued when you got in, when you purchased this vertical put credit spread or sold this vertical put credit spread, because we're a seller of premium, right? We're selling this. So when the market is where you want it to be, and it's just dropped or something, a good company dropped, you can get a vertical put credit spread, and as it starts to recover, let's say it dropped, and as it starts to recover, you'll start to realize money immediately. And you give yourself enough time, and if you're wrong, you can roll the option out in time until you're right. So there's some risk management here too. There's some defense to this trade, other than just buying a call or buying a put. When you buy a call or a put, you're The reason why this strategy is better is because when you buy a call or put, you're betting on implied volatility. And if implied volatility, which means the range that the stock is trading in, if the momentum slows down on the stock, even if you're right on direction, if the implied volatility goes down from when you bought, or when you bought that put or bought that call, you will lose money. So that's what's up with that. So I think buying a call and buying a put, if you're just betting on, it's not an effective way to bet on direction, or at least it's not the safest way. I believe this is a better way to bet on direction. It's a vertical put credit spread, which is bullish because you are a seller of puts, right? So you're on the sell side. So when you're selling a put, you're bullish. And the call credit spread is the exact opposite. And I'll show you what that looks like. Same thing. The exact same thing, except you're bearish. And then the short strike is the lower one, and the long strike is the higher one. So it's inverted. Okay, we don't like doing call credit spreads because the market is mostly bullish. And if you pick a good company that's gonna go down, and it goes down and you don't get out of it soon enough, it might not go back down. You know what I mean? Even if you pick a bad stock and it goes down, if the market gets bullish, even bad stocks go up. You know what I mean? So I don't really like doing call credit spreads. I think the vertical credit spread is where you want to be. Also, I have a Discord where I call out all my entries and exits. And there's a lot of education videos and a lot of cool people in there. There's a 7-day free trial. It's $15 a month. There's a lot of people in there right now that you can talk to and learn from, and it's a really great group. I recommend you click the link below and join. If the link has 3 dots at the end, because I think YouTube is doing that to me for some reason, just delete when you copy and paste it in your browser, just delete the 3 dots at the end. So make sure to be aware of that. But the link is definitely in the subscription in the description below. Make sure to subscribe. Please subscribe, guys. It helps out a lot. And hit that like button. It really helps out. And tell everyone I'm consistently profitable with this strategy. I've been doing it a while, and I seek to help others be consistently profitable too, if it fits within your personal risk tolerance. So go ahead and let me know what you think about this track too. I really like this music that I do. It's a different track every time. And make sure to comment below. Say what's up. Alright, guys. That'll be it for me. Deuce.